What do you think about debt versus equity fundraising?
From a corporate finance perspective, right, you have to determine then, what is the cost of borrowing for you.
You really want to lock people in equity in a long-term relationship and stuff, right? So it's just like the way to capture talents and also, like helps that you need. Taking that may make you look desperate sometimes.
One big thing most SME taukees out there you definitely should consider, it's really thinking about getting a very small debt and to start the relationship with the bank sooner rather than later.
Hello, everybody. Really excited to have us all together on this live stream.
Yeah.
So today we'll be talking a little bit about SMEs and really about the question that a lot of SMEs have, which is how do I have more capital to expand my business or to turn around my business? So that ranges from equity to debt to grants. So lots of different thinking about that. But what we'll just do is do a quick round of self-introductions. For folks, I'm Jeremy. I'm the COO of Lucence, which is a biotech AI company. I also am the host of these Brave Southeast Asia podcast, www.bravesea.com with 60,000 listeners. Happy to go around.
Sure. Hi guys, my name is Eldred. So I brand myself as the guy who kind of actually named his company after his son. So I'm the founder of Edenity. And what we really do is merger and acquisition for Singapore SMEs with a range of $1 to $10 million that are often overlooked by investment bankers. So that's a short introduction to myself. Maybe over to Waltson.
So everyone, I'm Waltson, founder and managing director of 28 Falcon Law Corporation. I've been a corporate lawyer for more than 8 years, and I support companies, especially startups, franchisees, help them draft commercial agreements, help them with their fundraising documents, series funding, mergers and acquisitions when the time is right. So over to you, Dennis.
Hi everyone, I'm Dennis. So I founded Legacy. So I'm managing partner of Legacy Consulting LLP. We do corporate services, corporate secretarial, accounting, basically on the execution level, but we also do strategic level things like say outsource CFO and outsource the chief of staff, helping clients with their fundraising completion and all this. So looking for money, that's sort of we help in closing the things yeah.
Super interesting. Jeremy, actually, where are we right now?
We are in FL Asia, which is the franchising expo. So lots of different brands are looking for franchisees, as well as franchisees or prospective franchisees looking for the right franchisor to work for. So
matching as always, right?
I guess this is the hinge for franchises, I guess.
Yeah.
So I think the first question, of course, is that a lot of folks who are tuning in, they're looking for capital. So I guess from your perspective, what has been your experience helping founders and business owners look for capital?
For me, I think it's very important to go all the way to the deepness of it and to the root, right? And what is it is, why are you even raising money in the first place? Typically for founders within a range of revenue between 1 to 10, they aren't exactly sure, right? I always believe there are your strengths and your weaknesses. And some founders are really, really good at scaling a business from maybe 0 to 2 million. But that's their limit. They need a different fresh pair of eyes, fresh pair of blood, I would say. And therefore, they're looking for strategic investors rather than financial investors. And that's a whole different topic, I guess, right?
Yeah.
So as I was thinking, right, the founders are typically the CEO, the CFO, the CEO, right? He's everybody. So the question then to him is about corporate finance, ROI, rates of returns. So when you want to raise money, you have to ask yourself, right, what could be the amount of money you could generate after you raise this money and you invest in your business. So I think like what Eldred said, right, you have to be very clear, very focused as to your purpose and whether or not you're going to get a return after you invest the money, right? So if all these are clear, then you can go ahead. And even with this kind of information, right, when you approach banks or private lenders, they may ask you, right, it could be their internal due diligence, how should they disburse and why should they disburse? So if you're very clear, then there's very good opportunity and very good chance that you can raise such funding that you require.
Actually, I am very much inclined to Eldred and Waltson.
We
right?
need a devil advocate here.
So but I'm gonna say something against that, right?
Sure.
But the thing is, yes, I agree. Most of the time, actually, the clients we spoke to, when they come to us, say, "Oh, I'm gonna fundraise. I need to get certain things done. So get me prepared for it, right?" Usual question is, why are you fundraising? I can tell you really, most of the time, I think I will need some money. I'm not too sure how I'm going to spend it yet. Then my more important thing was, but do you know how much you need or not? And they all stuck with that also. Maybe this, maybe that. I think it's fine. But the thing is, more important thing is very much inclined to them also is towards that purpose is important. But what I chanced upon before also, probably because a lot of startup, like tech startup and stuff also I work with, right, treat it as a milestone. So it's like, if I don't fundraise, I'm not wearing that badge of honor, you see. If I'm a startup, I need that badge of honor. So in fact, some of them perform well enough that they may not need the capital because they're sort of break even and stuff. But yeah, to them, it's like, it's another sort of milestone they want to achieve and stuff. So I thought that was an interesting point. I do meet sometimes maybe 20-30% of the chance I see.
And just to add on, I think for that's why I don't quite like the tech scene, right? As usual, tech scene is a little bit of an inflated valuation. I love traditional SMEs that have good cash flow, a little bit low, right? So they don't really need that badge of honor per se, right? And at the end of the day, is the badge of honor really worth it? The moment you raise capital, it's no longer fully your business. And I think that's something that a lot of founders don't really know that before they raise capital. But I'd love to hear your thoughts, Jeremy, on that.
Well, I mean, I think the key thing is how much money should you raise, right? Because that's often very much a question before they even start. They're like, okay, I want more money because my current business is not there where I want it to be. But then they often have this question, right? Is that I want $1 million, they want $5 million, $10 million, or maybe I don't need it. So how have you seen people approach that question of sizing that quantum? Because you also see the other side, right? Which is, people who are funders are very much like, how much money do you need?
Yeah.
So how do you think about that process?
At the end of the day, it's a little bit linked to the valuation game as well, right? Like how much do you actually value your company and at what value and what stake that you're going to give, depending on what kind of funding as well. We definitely have the debt, we definitely have the equity, and we could potentially look at other stuff like grants as well, right? From the government. Truth to be told, I think having that proper roadmap and business plan is the key. Because with that, then it's very clear that are you really taking on more risk? And why are you even taking on more risk and more money in the first place? Do you need to take the money now? Or do you need to take the money like 2 years later, right? These are the questions that we really need to grill and grind out of our clients or potential clients before we come up with a full concrete plan to go out to the market, at least for a merger and acquisition advisor for myself.
I thought to complement towards Eldred's point, further to that, I would say always go back to the founders, right? Or the CEO. Go back to the core team members first. I always go back to the very simple question, is value, right? Business model and stuff, very important, but it's a wrap over something, right? And the something is value.
Yeah.
Because of course we've seen startups that have like say, I got this amazing business model. I'm doing SaaS or tech lah. I know Eldred don't like it.
I don't like it.
Once you hear that, sensitive,
Okay,
right?
yeah.
But the thing is that people forget the core, which is the value. And value, simple to say, can be like simple things, functional, save time, save money, things like can be even higher value, like, if you like buy LV or Gucci and stuff, right? So association value also is another type of value and all this.
I guess it's brand value, the kind of thing. Yeah.
Really go back to the core. But I think we are all too busy, so we are rushing to pitch and all this, right? And then we keep focusing on our business model. We need to talk about partnership, collaboration, channel and all this. But then forgot about the key value. So and sometimes I ask the question straight. I say, okay, what exactly is a key value you put onto the table for a client? And once that got started, right? Then I guess it's a good stepping to valuation and all this. On another way to look at it, valuation, of course, you need to compare with like competitor. Eldred is very good at that, right? Competitor. Look at like what is that the package you have, your team. There's so many factors. Valuation is very hard to really determine, I would say, but need some professional help. Yeah, so that's I think it's quite critical to look at. Yeah.
So one of the interesting pieces is that people are thinking about certain amount. Let's just say they decide on $1 million, $5 million, $10 million. And then they start thinking through like, what are the sources of capital? And so, of course, we talk about equity, fundraising. We'll talk about debt, and we'll talk about grants. So,
there's actually a fourth one. Get it from your customer, right? Get more revenue. So
like
all the SME talkies like you're watching right now, right? It's like the best money to take is from your customer, right? And alignment of interest is the key to everything. Whether is it investors, whether is it debt, whether is it grant, and customers. If customers sees the value, they naturally will pay more. So in my head, every single time when I actually talk to any of my clients or potential clients is, are you really optimizing how much you're taking from your client? And can you actually provide more services? Because relationship once built, it's like an untapped CPU, right? You typically don't actually fully use everything, right? You could actually provide more services and really kind of actually, for lack of a word, squeeze and juice it out of your client. And ideally, your client would also benefit from the services that you're providing.
Yeah, I agree with you. I think customers are really important. Yeah, and obviously, I think there's the best source of capital wherever you can. And so, if we're thinking about, obviously fundraising as a process, how do folks think about it? The order, the sequence, any preferences? Government grants first.
For me, I'm thinking, definitely tap on the government grants. I think the Singapore government has been really helpful, providing a lot of support for SMEs as much as they can, right? The rules are all over the place, but they do have some portal.
Government grants are very slow, right? SME Tauke's out there, you definitely will know, right? Just apply for it. It's very slow, very long process.
So then the way to think about it is do different processes concurrently, right? Think about fundraising from even banks, right? Bank borrowings, or thinking about how much equity you want to carve out to potential investors. So I see the way that I think about it is if you borrow money from the bank, then you're subject to the bank's list of covenants, right? The do's and the cannot do stuff. And then when you start fundraising by way of equity, giving out equity for a piece, maybe a few bucks, right? Then you have to start thinking about how much control you're going to cede to your investors, right? Are they going to be able to dictate the direction that your company is heading, right? If you are thinking of expanding to this particular country, what are your investors going to think about it? So I think you have to think about how much control you're willing to cede, right? For government grants, you don't have to cede any control. You're in the driver's seat. For banks, you just have financing covenants and a few things that you can't do. And then especially for investors, where they can say even more things to you to restrict you. So you have to have a balance, right? What's the level of comfort you're at? And then you go on to decide.
Actually, since we are talking about government grant, I want to hear your thinking, right? That we know that government grant is not just I give you money. It's you spend, I reimburse you.
Yeah.
Any sense about that, guys?
A lot of my clients, and even for myself, right, there is the option to kind of actually get a registered management consultant so that or my clients can tap onto Enterprise Singapore grant for like my various services, whether it's industry research and competitor analysis, etc. The thing about it is two things, right? Number one, like you mentioned, timeline of it. Some of our SMEs can't afford, right? They are trying to make ends meet, but they also need these to elevate to the next game, right? And with this form of disbursement, it's a little bit of a holdback, but it's also a qualifying for the Singapore government, right?
Here we go.
So it's like, if you can afford to actually pay, let's say, for example, the 60 grand, the 80 grand, or the 100 grand, then you are ready and serious into it. So I think from the government's perspective as well, is they also want to hedge their risks and they want to ensure that anybody is tapping onto the grant has skin in the game. And that's the way to do it, I guess.
Then other than that, right, government grant, because our question is actually about fundraising, right?
Yeah.
Then when should we take debt? Then I think we are more conservative here in Singapore with regards to taking debt. And I've seen other different countries, right? Maybe I'm not too sure this one, you all must correct me if I'm wrong, right? But like in the States, if you're a company, you set up, you can actually try to apply for loans straight away, right? But here, there's some qualifying, like maybe you need to run 1 year, 2 year, standards And that is what the practice is one thing. But like looking at debt financing, right, is I say I don't see much people looking at that if they can. But of course, the bigger companies, they always looking at that because it's smart to leverage about it. So helping the audience ask, when do we position for debt financing? I think it's one of the biggest questions to answer. Any sharing on thoughts on that?
Well, I think that just to wrap up the point for the government grants as well is that, I think that the awkward reality is that there are a lot of bad faith actors out there, right?
Bad faith actors. And so, I'm going to quote you on that one.
So, and I think it's really the reality of the world, right? And so I think working on a expense reimbursement for the right CapEx or investments makes sense, especially when there's accredited providers or services that make sense. So I do think that the overall Singapore government is on the right track on the government grant side. The interesting part, of course, is that I think government grants looking at also investing in a lot of the new wave technologies that have come up, better providers. And so to some extent, the list of accredited providers or services can be refreshed more up to date in a way that, because otherwise we're always implementing the last wave of technology now, right?
Yeah.
Which is not really so I think when the newest wave of technology that bypasses some of the legacy, easy to implement, lower cost actually for the government to reimburse as well. Those are opportunities they have. So I think I'll put that on one side on the government grant side. I think in terms of thinking about debt, I mean, speaking about it, I think people often say that debt is cheaper than equity.
Yeah.
So what I mean by that is that, if you borrow $1 million, well, you're paying about 12% of interest, 13%, 14% today's market.
Yeah.
But it is 12 to 15%. And once you pay it off fully, then it's gone, right? Whereas if you sold 20% of your company for $1 million, that means you're going to give up 20% of your company's profits in perpetuity, right?
Yeah.
So I think there's an interesting piece, which is that you have to figure out what is the right mix for folks. What do you think about debt versus equity fundraising?
So I think from a corporate finance perspective, right, you have to determine then, what is the cost of borrowing for you, right? If you think that you're likely to do well, then you definitely want to give up as little equity as possible. And there's also another perspective. While you're giving up, let's say 20% of your company, you could bring in a strategic investor who could even propel your business even further than you could even imagine, right? So you could, without this guy, your revenue may not even be growing as fast as what you can get when you have this kind of investors on board. That's something to think about as well. Right. So if you're only thinking about giving up equity to a financial investor, then maybe it's better for you to consider just purely bank borrowings.
You know what? I really would like what Jeremy say because he's an angel VC, right? When the VC say that, hey, it's cheaper to get debt. Okay, hear you. Actually, yes, I think that's definitely one of the things, but I will look at it more of like instrument, right?
Instrument.
Yeah,
Okay.
way of like instrument, right? So I touched on the equity first, right? You really want to lock people in equity in a long-term relationship and stuff, right? So it's just like the way to capture talents and also, like helps that you need. I call it smart money. Money also got different color one, right?
Of course,
So
for sure.
I think
For sure. But you're talking about different note, green color,
green, orange. My favorite is
purple.
the purple one.
Purple, your favorite. Okay.
So the thing also would mean a lot towards like say, can I say that this is a bit also like can be controversial, right? Taking that may make you look desperate sometimes.
Maybe I'll address that, right? And I guess we focus on debt for now. I think in the perspective of debt, especially from the banks, ideally they would only issue debt if you are in a healthy state. If you're not in a healthy state, typically they don't, or they charge you a higher interest, right? But when you're in a healthy state, you don't need that, right? So I think one big thing most SMEs should consider, and SME Tauke's out there, you definitely should consider, it's really thinking about getting a very small debt and to start the relationship with the bank sooner rather than later. Pay off the interest is like a charge that you really need to do. But when time push comes to shove, you're already their client and they kind of actually see your payment trend already. It'll be easier for them to kind of actually give out a bigger quantum when it is needed, right? So I think that's on the debt side for SME Tauke's to really think about. The other side of the debt, right, is a risk and reward kind of thing. If you kind of take all of the risks, you kind of take all of the reward. Think about debt is you are taking on most of the risk. If you're taking equity money, right, the risk is borne by the investor. And therefore, the investor should be handsomely returned, right, for the value of time, right? So those are the things that you really need to think and consider. But it all boils back down to the same thing that I always tell, right, is do you even need the money in the first place? Or is there any other ways around it? And what is the timeline? The longer that you can drag on in terms of fundraising, the better for your company. Because ideal world scenario, you'll be very, very different from today compared to 1 year later, right? And imagine if you can actually drag on that investment timing to 2 years, 3 years later, you might be a whole different company altogether, or your company might not even exist, right? So it boils back down to really that risk and reward and how to kind of actually juggle between that.
It's a very good point you make about like sometimes you take loan, a small one, right?
Yeah.
Is to build that relationship. But actually that reminds me about like somewhat like similar to personal, right? If you can, you always start to take a small like, credit card, right?
Yeah.
Because you build that credit interest and, all this built up that you can pay on time and all this. Like I heard this is a thing, right? The credit report and the health, credit health.
Especially in the States.
Yeah. And you don't suddenly just cut off and then suddenly you drop on the rating. That's what I hear. So does that apply to like businesses, you think?
From my experience, I guess a little bit, because the key thing is the bank doesn't know. Bank has their own KYC procedure, their AML procedures, etc. But the best procedure is really understanding you as a client, right? So if you can actually start that relationship earlier, right? Then there is some precedent. Oh, this guy is a good paymaster. He does pay on time, right? So I'll be comfortable with giving him slightly more than usual compared to if you're in a dire state, you can't actually go, I need 3 million right now. They're like, I don't have a relationship with you. Maybe no, right? So I think that's the friendly advice that I'll really give to all the SME taukees out there that are watching.
So Eldred, I have a question for you then.
Yeah, sure.
From a law firm's perspective, I'm technically also an SME, right? How much money should I borrow from the bank and at what rate should I pay off the interest? Because credit card is free borrowing, but then now I have to start a relationship, right? So how much coffee money must I give them?
I think for your case, it's a little bit different, especially for services like what we are doing right here, right? For services, ideal scenario, you're looking at a higher ticket item, right? And you really don't need, for lack of a better word, that external financing on the onset, right? So if you were to ask me, it really depends on the relationship that you're planning to build and what is the quantum that you're potentially going to raise, right? For me, I would say somewhere in the range whereby you're very comfortable with the interest that you're going to pay. And it's something that you can, okay, this is something I'm willing to pay for that relationship. So the question goes back to you actually, Waltson, is like, what is that amount, right? Like you are relatively comfortable to pay for that friendship, right? For lack of a better word, friendship with banks, you know, that kind of thing. But
It's like protection money.
Right, like protection money, exactly, right?
It's like,
protection money.
friendship,
Yeah.
2% only.
Yeah, exactly.
I'll never imagine this conversation to have friendship suddenly out of nowhere.
Every time with Eldred, is always mixing personal and
friendship.
professional. It's one and the same, right? I named my company after my son. Everything is the same. Yeah.
Nice.
I would say that I think it's a good point that you make, which is that businesses that are more product businesses and there are other companies that are more services or have more of that recurring transaction. I would say that one form of capital that people do underutilize is actually receivables financing.
Yeah.
So working capital loans. Because if you look at the quantums, there's a lot of companies that are making like 1 mil, 5 mil, 10 mil revenue, I'll say. But then actually, if you look at their cash, there's about $1 million to $2 million that's just locked up at any one time because it's either, kind of like waiting for your payments, your client is taking 60 days, 90 days. So I think actually one of the good things is that there are actually quite a lot of providers like banks. There are also newer startups like Fluid, Fluid, that does this kind of like, they call it invoice factoring. But basically, they use your invoices as collateral in that sense. And then they will give you the cash up front. And they can free up $1 million. And actually, if you free up $1 million of cash, you can actually start investing quite significantly on a recurring basis. So I think underappreciated where people kind of like, oh, I need to do equity or debt. But then if you can do a grant and you can do receivables financing, you can maybe get like 60, 70% of the way there.
But actually, I think one of the concern, I feel for like clients, companies, I think it could be a mindset, right? It's meant for the companies with like 1, 2 mil, 3 mil of like AR outstanding and stuff like that. Do you mind to like share, right? If you all have any experience also, and to help the taukees, right? Also to think,
anything for SME taukees.
Yeah, anything for them, right? What should be the minimum gate to consider invoice financing, like factoring?
I think the question is whether you need it. That's one. But two, of course, is actually, I think, a quantum. So I think I would say that if you have about $1 million of invoices, the working capital locked up, I would say that's actually a pretty good threshold. I think $500,000 could be like your minimum threshold to start exploring. And I think it's good because I would say that if you have about $500,000 of, invoices, I think one of the big things that you need to do, of course, is upgrade your finance system.
Yeah.
Make sure that you're chasing them to pay on time.
Correct.
So those are things you need to fix. But I normally find that once you hit about $1 million, maybe you're already squeezed, you're already optimized. But now it's just the fact that, hey, on average, the market takes about 30 to 60 days to pay. So I think the good thing is also lets them take some of the risk for collections as well.
To add on, in my previous capacity, I used to be the person to kind of actually give those loans, working capital loans. Back then, we were looking at a relatively smaller quantum. So it goes all the way to probably even like 50,000, all the way to probably 2 million. Back then, we were looking at green financing companies. So green companies like solar, water, wastewater. So there's a dual purpose for that. But I think one thing to really think about is, as all businesses, it's always going to be the case. Increase my revenue, decrease my expense. And this morning, we were talking about decreasing our cost and expense. But the other thing to also always do, right, is to collect your money as fast as possible in terms of accounts receivable and paying as slow as possible, right? And then you have the arbitrage, right? Just look at Starbucks, right? Like the moment you top up the Starbucks card, it's cash in for them, right? And they can do so many things with that cash, right? So with that in mind, working capital is something that all SME taukees, regardless of the size, right, would be thinking about. Because when do they kind of actually want to get more revenue? When would they want to actually get more money? is when they realize money in the bank is not enough.
Yes.
Right? And you wouldn't want to fall trap into really, really not enough, then you go and find, right? It's always going to be a process and you don't want to live life on the edge, right? Even though I always joke as entrepreneurs, we are living on the edge compared to our stable corporate life that we had last time, right? Whereby the paycheck always comes with or without anything that is going on. So I think quantum-wise is really relatively subjective, but finding the right investors for your quantum would be the magic thing to look at.
That's a good point.
So as we look at debt, obviously, I think people, like you said, are both hopeful for debt. And I think we're talking about the positives, but people also get scared about debt because they hear a lot of like horror situations. So I think we have lawyers, but we also have many of us who've actually seen those horror stories as well in action.
For sure.
So I think first of all, let's name it, I was an elephant in the room, which is what is the horror story here? Now let's talk about preventing the horror story. So what's the horror story that people have heard or seen?
The worst case scenario is when, you are directors of the company, you become personal guarantor, right? The moment you become personally involved in the borrowing, the bank can go after you. So they can take all of your possessions away, maybe leaving you with your HDB thanks to the system again. So there are safety nets as well. So I don't know how bad is the worst horror story I've not come across personally.
I just seen one recently actually. Service interesting. So but the thing is, one of these major shareholder who was a director went bankrupt. But there's a few other partners right? In the few directors running it. Bank immediately call in now. Of course, it's like, your PG bankrupt so I must collect back the whole corporate loan I gave you all and stuff. But I want to bring this thing in, which is quite a very good point to what Eldred has said. They been a good boy, so they pay. They're very nice. Not only on time, earlier.
Oh, okay.
So those really help,
Yeah.
And then they went to mitigate with the bank of course. And it wasn't just one bank, a few.
And all the bank, they are good boy or good girl, right?
Yeah, of course. Good boy and good girls, right? So then the thing is, I think it's very important on Eldred's point that, it's a certain behavior, right? On treating, but although we try to pull our working capital and all this, I know we all have to,
We all have to stretch it,
as
man.
business owners, we have to sort of safeguard on this, right? So our job at the right point, right? So on this, then these points are very helpful, especially on these cases, because it's still flexible. It's the things we can work out and all this.
Yeah.
So it's something to take note of.
Yeah, so maybe I'll say a juicy one, a horror story. But back then I was putting on a hat from the investor point of view or giving that. So context-wise, it was a company in Philippines whereby we actually provided a loan, not too big. I think it was roughly 100,000 and we top up an additional 50, so roughly 150,000 US. In Philippines, it's a different ballgame altogether because for those that are a little bit younger, they don't even know what is a check. But in overseas countries, especially like in Indonesia, India, Philippines, checks are still their main go-to. We collected as collaterals or securities from an investor point of view. Personal guarantee is definitely one of them. But interestingly, one thing that we actually took is actually post-dated checks. So checks that has already been written in number, in quantum, as well as in terms of date as well. And we actually hold that in. In the event, we just keep cashing in, right? So if there's going to be a bounced check, there is quite a big legal implication, especially in Philippines. And it could even go all the way to like the person maybe going to jail, right? So we did actually bounce 2 or 3 checks and it was literally going to be a legal case. Long story short, in the end, the owner is like, I really can't pay. I can't actually use the money for something else, not really for the business. And we had to actually remediate. But the post-dated check really did have legal implication, especially in Philippines. So all folks out there, that is definitely scary. And that's why risk and reward is always there. But be very clear and intentional in terms of what you're going to do.
So how do people avoid this debt issue? So first of all is maybe try not to have a loan that has a personal guarantee. I know a lot of people.
But no banks will kind of do that, right? So that's always going to be a chicken and egg, right?
There's the venture debt fund. So.
Venture debt fund. Another story for another day, I guess.
Yeah. I guess when you grow big enough, you can stop being a personal guarantor at some point where your company itself has enough assets to collateralize against your bank borrowings. I also recently came across this information that actually debt, if utilized well, right, can actually propel you to greatness. So, for example, people talk about Robert Kiyosaki's $1.2 billion debt, but they don't know about his net worth, right? To people, 1.2 million in debt sounds scary. But if you compare it against, right, his net worth, how much assets he really has, and how much are those assets actually generating even more assets or capital for him, then contrasted against the amount of debt you have taken on, you will find that actually those debt are good debt, right? So debt can be seen from the wealthy people's perspective as good debt or bad debt. So you have to think about, right, how are you going to play the game in the sense?
I think the thing is like it's going back again on the same things. I feel that sometimes we're gonna be speaking the same thing, right? Intention and all this, right? I'm sure all of us in our life will have gone through some part of debts. Whether it's a personal
Housing debt, confirm, right? Like,
housing debt for sure.
Unless you're very rich and then like, you can buy like
and-
1 mil and that kind of
But
thing.
HDB debt is that
yeah,
one is
any
guaranteed by
kind
the
of
state.
debt,
But I also agree that, business owners, we sometimes live on the edge, right? And it's not just because we choose, but you're going to take a little bit of that to push, right? If not for the push, then how? Things are on stick. But then the thing is always have your financial plan out. I think the financial part is always very critical. I mean, I'm lucky. I have accounting, for the finance game partner, right, with me. So he's my guy that I will run to him first. Can do, cannot do. Counter check lah, So I always make sure got counter check before I go and make any decision and stuff, because sometimes you think it's great, it's all in the head.
Yeah.
But then when you check with reality, then it's all started to fall apart and stuff. Counter check is also definitely one of the things I encourage people to do.
So now switching gears to the other side is equity, right? And then we said it was like, if you're in a good position, go raise debt. And then if you're not in a good position, go raise equity. It's like, oh, okay.
Yeah.
But it's true that in an equity investment that you're seeking, the risk is borne primarily by the investor, because they're buying a minority stake.
Yeah.
They don't have control rights. They don't have these covenants and everything. So quite interesting question that we have together here. So when should people choose equity?
I guess strategic partner. I think kind of go with that. Because if let's say you're going to be a debt partner, there's no skin in the game, right? If you're going to be grants, no skin in the game. Customer money, debatable. Really depends on whether they look at you as a business partner or a pure vendor, right? But if you're looking at equity, ideally speaking, when we can actually do M&A, especially for an advisor role, we can actually split the two categories, right? Strategic investors and financial investors. I think most of us are very well aware of what is financial investors. I give you X amount, I expect X amount in X amount of time, right? That's pure, very simple financial investors. What will be really relatively interesting is strategic investors that could propel your business, but they could be also competitors of yours, right? So there's always going to be a fine line in terms of what is an ideal strategic investor, and for lack of a better word, is the strategic investor just poking in to just get information about the industry as well. And that's where an advisor is extremely important to kind of actually sieve out the noise and ensuring that there's an alignment of interest.
On top of that, right, giving out equity as like a reward to lock these investors. After that, they entice them to invest. That could be a play also. I mean, I've seen that before, so I thought that is an interesting point. Because sometimes I'll say there are advisors that are just like looking, okay, should I put in or not put in? Should I bring all my, like my lobangs, my contacts, all this, and that they have this, but it's more of this dating period and stuff.
A very good point in terms of the dating period, right? So most of the M&A, I always say, starts off with the low-hanging fruits. And what is the low-hanging fruits? It's you can actually have, let's say, vendors that you already spend so much time. And instead of paying them as a vendor, why not just buy the company up? That's from a bigger company perspective, right? And with that, you can't actually date, right? I often say merger and acquisition is the highest form of partnerships. And partnership stands with a lot of relationships. You don't date the first girl you marry, right? So that's something for you guys to really think about as you kind of actually explore the various options as well. So yeah.
So the way that I think about it is also, there are instruments such as convertible notes, right? Where you borrow money first and then you start, start the
technical terms now.
relationship.
Okay.
You share some information and then, there are thresholds at some milestones, you convert it into equities based on certain preconditions that you've agreed to in the contract. That's something to think about also.
Throw in another sexy term, safe note.
Oh.
You're right.
That's where I'm out, man. Most of the tech people are using these kind of terms. No, I'm out.
Yeah, but I think on that, right, then, I have to say, finding a good lawyer very important. Because later you take the agreement, you just say, I want to marry you fast, right? So just take one of these template, then you just start 2 page, 3 page, can go already, ma? That's where. After that, when you all look back again, oh no, what did I say? And actually, I want to bring that to Waltson, right? So, like, have you encountered clients that are saying like this, like, oh no, I got into trouble already. I signed, but then I'm regretting it. Then how do you deal with that? Like, especially in equity and stuff, you can't regret, right?
All the time.
All the time. All the time.
Wow.
People like maybe a franchisee, for example, he signs an agreement with a franchisor, and then in the agreement, they were not legally advised. The franchisor may already know the game plan down the road. How are they gonna take money from these people? So when these people, like you guys have been saying, right, you get so excited, you sign, you think that you're a business owner the next day. Wow, So that feels very good. But when the franchisor, for example, or the other party stops fulfilling their obligations in the contract, that's where you start to worry. And that's where you say, oh, they have been defaulting payment and this is the amount of money. It's time for me to now look for a lawyer. But when I usually see all these agreements, I can tell you the terms are so unfavorable to these people that they technically could not even get back a single cent. So what are they gonna do, right? That's the key question. So before you go into a legal relationship, you have to think about the legal impact and your backup options. What's going to happen to you if, for example, the other side defaults, right? Because the legal agreement is to protect people who do not trust each other. If you trust each other, this is just a piece of paper. And if you don't trust each other, then you better get it legally reviewed. That's my point of view, personal point of view.
That's why lawyers are usually your best friend, right? I trust my lawyer. That should be the case.
Correct.
I think that's a very important point. A lot of people just like, lawyer, then do we have to pay man-hours straight away? Make friend first. I'll just say make friend first.
Yeah. Make friend before you date. Yeah.
No, I think the funniest part is, I totally get it. I've seen a lot of business owners who are like, wow, lawyers are so expensive. I can do this myself.
But losing out on the financial gains that you expect would be even more expensive. You never get into financial ruin hiring a corporate lawyer to look at your agreement. But you might, spend too much money litigating a situation where it already goes to the point where you're in a stuck position.
And so there we are, obviously thinking about this in terms of equity. So let's just say, how do people think about the process of raising this money? So we've talked about grants, we've talked about debt, we've talked about equity. How should people think about the timeline and the process of going through this fundraising process?
I advocate like startup governance.
okay.
Corporate governance, right? But then on a startup level, because corporate governance can be, some people say too high to achieve, right? And it can be a dry topic. But then the thing is, I think it's important to have first thing is your CorpSec, right? Company secretaries, in case you don't know what is that, company secretary and accountant. That's why lawyers and company secretary also very good friend, because we start from first talking about like, oh, you want to do something, okay. Then you need to look at, if you're running a company, you make sure you're doing the right things. Have you seek for your other shareholders to approve? Have you passed to the board? Have you passed to the shareholders? All these processes. And then you still have to talk to the lawyers. I mean, I usually have to take a quick look at the shareholders agreement first. Then I say, hey, you better talk to your lawyer. Clear those requirements first. So start from there, right? And then I can tell you that you need to pass resolution for sure. And for all this, whether is it debt or equity is the same thing, right? So get that first level, right? And then usually the company secretaries can actually also say, you need to talk to your lawyer about this. And then that's your second layer. That process, right, is, I would say, more stable. Because I also seen before, like, people just immediately take and sign, right? Then after that, come back and say, no, the shareholder say, I didn't agree. Then the lawsuit, it starts from there. If you don't say lawsuit, then the confidence in the company being run, it's gone also. Then a lot of all these like quarrel and dispute starts to happen. So governance is one thing I definitely advocate. It can be looked at even from an SME level, should look at, So,
Yeah, I think before you start your business, you have to ask yourself, do I want to be a person who is very good at doing the business, right? That's one thing. If you are very good at, for example, creating furniture and selling furniture, then you focus on that. But if you're thinking about starting a company, expansion, growth, that's professionalizing your business. If you want to professionalize your business, then you have to go with the resolutions that you need, right? The proper approval, the very professional way of doing business. So that question you have to ask yourself as an SME tauke, right? Do I want to continue doing that thing that I'm very good at, and then the rest of the things I don't know anything about this or that? You have to ask yourself that question. If you're serious about growing your business, expanding, get bank borrowings, later on selling equity, then you have to start from at the ground zero. You have to already be prepared for the day to come. That's where we are coming from, right? You have to be professional from day one if that is your intention to grow.
So could everybody just quickly share how people can contact you if they want to engage your services or become your friend?
I do videos on Instagram and stuff. So y'all can find me on Instagram, Dennis the Po, P-O-H, okay, not Poo, Po. And Facebook, Instagram, LinkedIn, you can find me also. Just feel free to reach out to me. I'm doing more videos every month. Every week I will have. Still thinking what's the food next. Maybe coconut. Go find good coconuts. Right?
Sure.
So to contact me, my name is Waltson Tan. You can find me on LinkedIn. Alternatively, type in 28 Falcon Law Corporation. That's the law firm that I'm running right now. 28 Falcon is actually the apartment in London that I used to live in when I was an undergraduate. Yeah, so 28 Falcon Law Corporation.
Yeah, so for myself, I'm relatively active only on LinkedIn. So probably you can actually add me up, Eldred Wee. And I still pride myself as naming my company after my son. Personal relationship and professional is one and the same. So that's where you guys probably hit me up. And Jeremy, yourself, I guess.
Yeah, you can find me on LinkedIn as well, Jeremy Au, AU. And also I host the Brave Southeast Asia podcast,
Nice.
www.bravesea.com.
Check it out.
All
Yeah.
right. On that note, thank you so much, everybody, for sharing your wisdom.
Thanks
All
for
right,
having
cheers,
me.
guys. Thank you so much.
Thank you.